Hey, if you're just filing in, we're going to wait a couple more minutes to start the actual presentation. Hey, everyone. Thanks for joining us. Looks like folks are starting to file in. We'll begin in just a minute here. You can use the chat function up here. I think you can see that to ask questions if you have any. You can also let us know if you're having any technical problems, and we'll see if we can help out. Thank you all for joining us today. I'm Megan Coelho with Advice Chaser. I'm actually the president of the company. I'm filling in for our usual webinar director today. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We are thrilled today to bring you this educational presentation. Just so you know, attendees are muted, but we do encourage you to ask questions using the chat box. I will show you that right up here. So the presenter, David Eads, will answer those questions for you during or after the webinar, depending on the flow of his presentation. If you do ask a question in the chat box, go ahead and leave your phone number there as well. If we can't get to your question during the event, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so don't hesitate to ask for clarification or expansion of the material. So now on to today's presenter. This is David Eads. He's the founder of Vital Investment Management and holds the designation of Certified Financial Planning Professional. Since he was 8 years old, Dave has had an affection for investments, which started in 4th grade with a stock picking project at his elementary school. Dave possesses extensive experience in tactical investment strategies, comprehensive financial planning, and tailored retirement planning. Having spent many years in the investment industry, he can devise unique strategies to manage his clients' investments and personal finances effectively. Dave works very hard to create a mutually beneficial and long-term relationship with his clients and their families. Dave lives in Northern Colorado and serves people throughout the country. So Dave, I'll pass it over to you. Go
All
ahead.
right. Thanks, Megan.
Oops, I did not advance the slides. What's in your portfolio? An intro to investments.
Well, thank you for putting this together, and thank you all for joining. The presentation here is very high level, and I wanted to make sure that everyone has a chance to get a basic understanding of investments, the different tools that you can use in investments, and some of the different types of investments that are available. The most common investments that you will hear of are stocks and bonds. And in general, those are what you hear about on the news. The stock market has done, plus 100 for the day or down 100. It's really hard to understand those terms unless you have a basic understanding of what a stock actually is, or what interest rates are, or what bonds are. So the best place to start would be to discuss what's in a typical portfolio. And most investment portfolios have stocks, bonds, and or cash. Now, cash we're all familiar with. If you make a deposit at a bank, you may get some interest, you may not. Historically, you would get some sort of an interest rate for a deposit at a bank. And that is the safest money typically in a portfolio. The cash is designed to buoy the portfolio from making a huge correction from stocks, or potentially even from bonds. So we'll go into those different investments in your portfolio, and then we can get into a little bit more so that there are investments that will hold multiple stocks or multiple bonds, and we'll get into those details as well. So I think the best place to start would be with stocks, and that would be what is a stock and how does it impact you? So if you own stock, you own part of a business, and those businesses can be public or private. If you own your own business, if you're an entrepreneur, you would then own stock in your small business. The stock market is the larger companies which will go public and offer their stock holdings directly to the public. So you can actually go and buy a piece of ownership of Apple or of Microsoft or of so many different businesses out there. And when you buy that ownership, you then are entitled to a fraction of their profits and a fraction of the assets of that business. So the goal when purchasing a stock over the long term is for that business to continue growing and continue being profitable, so that you can reap the rewards of the ownership you have in that business. So the risk to a stock owner is if a business goes bankrupt. So if you own stock in a business and they start losing money and eventually file for bankruptcy, you may end up losing your entire investment. So stock owners are because you own part of the business, if it goes under, of course, you could lose your entire investment. Now, that's not all that common, but it is certainly a risk that you have to be aware of. And some large companies have gone bankrupt over the last few decades. A few of the most notable would be Lehman Brothers, which was an investment bank in New York, and Enron, which was an energy company in the southern United States, both of which owners in those companies lost all of their money. But over the long term, if you own stocks, you should have performance better than the overall economy, because stocks tend to outperform the average economic growth of the United States. So owners of stocks are typically long-term investors. You're trying to gather the potential growth and profitability of that business and reap the benefits of it over a number of years or even decades. There's different types of stocks, and we can go into some of the common terms that you may hear, which would be large cap versus small cap, growth versus value, preferred versus common. So I'll go through some of these different terms. Large, mid, and small cap stocks are designated as such based on the size of the business. So that the overall value of a business, and a value of a public company is called its market capitalization, which effectively is the number of shares or units of stock that are available for that business times the price of the shares. And so if you have, say you have 100,000 shares outstanding and it's worth $10 a share, that would be $1 million valuation, $1 million market cap. So large cap companies are the biggest companies in the United States and really globally. And those would be ones that you're very familiar with. Again, Apple, Microsoft, Tesla, some of those names. Mid-cap stocks are not yet large, and they're no longer small. And historically, mid-cap companies tend to perform the best over the very long term because they've grown out of the small company phase into a middle company phase and still have potential to grow into that large cap phase. So mid caps are typically, for long-term investors, a very reasonable place to park money as they should continue to grow. And small cap companies, a lot of those companies are ones that you may not have ever heard of. They could be regional banks, regional businesses that don't have a national footprint yet, but are generating a bit of revenue that give their valuations enough to make them a public company. So if you're a small entrepreneur and you have just a small business for yourself, you're likely not going to go public because it costs so much money to list your business on an exchange. But once you get to a size of maybe a market capitalization of maybe $250 to $500 million, you could consider selling some of your stock on the public market, which is when the small cap stocks typically start. So they're $250 to $500 million market capitalization, up to $1 billion. That's typically what you see. Growth stocks are usually companies that do not pay a dividend, and dividends are the payments to stockholders as part of the profits. So if a business is making, say they've made $100 million of profit over the last year, they may want to pay out half of that as a cash payment to the owners of the company. And that's done as a dividend that's paid to you in cash. Now you could reinvest that back into stock, or you can keep the cash. Growth companies do not usually pay dividends. They sometimes are not profitable, but often they're companies that are technologically driven. What they're trying to do is use all of their profits that they generate and reinvest it back directly into the business and continue growing the business, ideally faster than the overall economy. And you see that with some, like the Tesla is a perfect example, that they don't pay a dividend, but they're reinvesting all of their profits back into the business to continue to grow it. So think of a growth stock as an aggressive company like Tesla. A value stock is one that pays dividends and has done so historically for many years. And some of those are more of the tried and true businesses that you've seen for years and years and years. For a long time, GE was considered a great value company because it paid a nice dividend and was a staple in many people's portfolios. But a value company is typically one that's going to pay dividends out in cash, and they are not going to grow as fast as growth stocks. They're usually less volatile with their price. Preferred stocks are not as common to see as a common stock, as the name would infer. Preferred stock, when a business goes into bankruptcy, preferred stock holders usually get paid out before common stock holders, and preferred stock usually does not have a dividend, although sometimes it can. So preferred stock, what you may see different, the same company with a preferred stock and with a common stock share. Preferred stock would be safer in the event of a bankruptcy. Common stock is what most people buy on the open stock market. There's nothing unique about it. You're a normal shareholder in the business that has a regular ownership of the business with no special ties or protections against your ownership. Blue chip stocks, so those are the usually what you would think of as the Dow Jones average. Those are large companies in the United States. Most of them pay a dividend. So you would be looking at the Apples of the world, Disney. Large companies in the US would be blue chip companies. Penny stocks are very risky. The reason they're called penny stocks is most of them trade below $1 per share and have very volatile pricing. A lot of them are not profitable, so they're highly speculative. You're just guessing or betting that if you buy these, that the price of those stocks will go up because there's no profit in the business. Usually there's a loss, and therefore these penny stocks often do not become profitable and usually end up dissolving. And finally on this list, international stocks. So international stocks are unique in that they're stocks in foreign businesses on foreign stock exchanges outside of the United States. When you buy an international stock, you're buying a stock in a foreign company, say Nestle in Europe, and you're banking on getting profitability and growth from a foreign country, selling to diversify away from just United States exposure. One thing that a lot of people don't usually understand, when you buy an international stock, you're actually, half of your investment is that stock and the other half is the currency in which that stock is trading. So say you buy British Petroleum and you would be buying a BP stock in the United Kingdom. So half of your investment would be the British pound, the other half would be the actual stock itself. And so you need to be able to account for changes in the currency valuations when you look at international stocks. Now you can hedge that away by getting rid of the currency movement, but that does come at a slight cost. Any questions on stocks here before we shift gears?
Yes, David. Someone asked, should you have a foreign bank account if you invest in an international stock?
Good question. No, you do not have to have an international bank account to invest in international stock. If you're using a big brokerage house like Fidelity or Charles Schwab, you will have access to some of those foreign stocks directly through your custodian or your brokerage house. Another way to access those stocks without opening another account overseas would be through exchange traded funds or mutual funds, which we'll get into later. But that's a very efficient way to access those international stocks without having a foreign bank account.
Yeah, that person says he wanted to see if there were any advantages or pros and cons, and thank you for the explanation.
There are potential advantages if, for instance, the US stock market right now is very highly valued. It's relatively expensive versus historical averages, whereas some foreign stocks are not as expensive relative to their historical averages. So it's a way to potentially get more dividend income, maybe be buying it at a lower price, or investing in economies that may be booming, like emerging markets. Say, a lot of those emerging markets would include Brazil, Russia, Mexico, India, China. And there's potential for growth there, but of course it comes with a lot more risk too.
Got it. Okay.
So a bond is the other large investment term that you'll hear. The bond market is the biggest investment market in the world. Over $100 trillion worth of bonds are floating out there right now. So it's somewhere in the neighborhood of 10 times as large as the overall stock market. But they're not as fancy. They don't have as much potential growth as stocks, so you don't hear about them as often. A bond is a loan that you as the investor are giving to a particular business or to a government. So what you're doing is you're giving them some money now. They're using it to finance operations or investments of their own with a promise to pay you back with interest over a certain period of time. Now, the interest payments are typically twice a year, and those loans that you give can potentially go bad if that government doesn't pay you back or that business doesn't pay you back. In the United States, bondholders almost always are ahead of stockholders during a bankruptcy. So if you are a bondholder and that business that you gave a loan to goes bankrupt, you're likely going to get at least some of your money back, likely not all of it, but at least some of it back, whereas the stockholder in that business probably wouldn't. So bonds are considered safer in general than stocks. The institution or business or government that you're loaning money to will have some level of risk that they will go under and not be able to pay you back. And that would be default for a business, so they go bankrupt, or like the United States government, the US Treasury is considered risk-free, and therefore is considered to have no risk of default. Of course, there is some tiny risk of default in the US Treasury, but they're considered risk-free bonds. Almost all bonds pay a higher interest rate in the United States versus a US Treasury bond. And the more risky the business, the higher the interest rate that would be paid to you in general. So small oil companies that are drillers will have a much higher risk of default and therefore demand a higher interest rate to bondholders. So there are different types of bonds out there. There's junk bonds and investment grade bonds. Investment grade bonds are typically bonds that would be very high quality and likely not going to have a default, whereas junk bonds, there is a reasonable risk of default, and therefore you want to be very careful in how you're investing in those types of bonds. Any bond specific questions?
I haven't seen any yet.
Okay.
One
One
back to it
last
later.
little piece on bonds. The price of a bond depends on the interest rate it's paying. And once the bond has been issued and it's out trading in the open market, if interest rates go up, the bond prices go down. If interest rates go down, bond prices go up. So that's one thing to keep in mind if you're a bond investor. If you think interest rates are going up, then you're also thinking bond prices will likely go down. So you need to be careful in rising interest rate environments when you own bonds.
Cool.
So the next term that most of you would probably be familiar with are mutual funds. Mutual funds are nice because they help diversify risk, and you can effectively eliminate business-specific risk by owning mutual funds of a stock. So mutual funds hold a basket of stocks or a basket of bonds. So you don't have to go out and buy individual stocks and individual bonds. You can just buy the mutual fund, which already has those holdings within it. So it makes it much more efficient and easier to track and manage. Now, there are some disadvantages to mutual funds. They have to pay out capital gains, realized capital gains at the end of every year. But mutual fund holders over the long term tend to do fairly well because they're diversified. They own different companies within the fund. And they also only trade once per day. So you can't go buy a mutual fund right now at today's prices at this very moment. They trade after the stock market closes, and therefore you're getting the pricing at the close of the stock market. So they're priced once a day. They're not as volatile typically, because the value of the mutual fund is the value of the underlying holdings at the end of the day. There also can be passive mutual funds, which means that there's no active manager making the buys and sells throughout the day. They're just tracking, say, an index instead of trying to be active and beating the overall stock market.
David, before you move on, there's a question that came a little bit later about bonds.
Sure.
Mind going back a little bit?
Yep.
Someone asked, as a younger individual, usually the allocation of diversification can be more aggressive. What do you recommend for investing in bonds for younger investors?
Sure. Well, that goes to risk tolerance, and there's two different types of risk tolerance that we look at. One is your financial capacity to take risk. If you're young, you have a long runway ahead of you in terms of earning years and savings years. Therefore, you don't need much in terms of bonds, because you can take the risks when you're young and make up for them over time. The other risk that we look at is your emotional capacity for risk. How much does the stock market correction affect you mentally? And if you can't sleep at night because you're thinking about the stock market and a correction that you're in, then you shouldn't be taking that much risk. So you really should be looking at it from both a financial and an emotional perspective. Typically, we give our clients, we can give them the answer financially. We can go through the numbers and say, here's how much risk you can take, but you need to buoy that against your emotional capacity. So if it's going to keep you up at night, then don't do it. It's not worth hurting your health. There's a kind of a rule of thumb that's been around for decades, and that is the percentage of your portfolio that's in bonds is your age in years. So if you're 30 years old, you should have 30% in bonds. That's just a very rough estimate. Everyone's different, but in general, that's kind of what the industry has suggested over the years.
Interesting. Have you covered what you're going to cover on mutual funds? Because I have kind of a question about the tax implications. Are they different for mutual funds and bonds? And does that affect, when you should be in each based on your age and things like that?
Yes. So stocks, you're only going to pay tax on a gain in stocks if you sell them and realize a gain, then you would pay capital gains tax. With bonds, they're going to pay out interest, and you would pay income tax on the interest that they pay. And then when they finally mature, if there's a gain there from when you bought it, you would have a slight capital gain as well. Mutual funds are taxed every year. So if the mutual fund has a 10% gain within it, a realized capital gain, then that is distributed typically in December every year. So you would get a capital gain distribution that you're taxed on. So mutual funds are slightly less tax efficient than buying individual stocks. So it is a little bit more tax inefficient to own a mutual fund. So you would need to weigh that against what tax bracket you're in, and then the duration of your hold. And if you're looking at bonds, a bond mutual fund typically isn't going to have huge capital gains, so they're not as tax impacted as a stock mutual fund potentially could be.
Interesting. I have a bit of a follow-up question there.
Sure.
If I'm a younger person who's investing, or an older person who can help me look at, okay, should you be in bonds? Should you be in mutual funds? Should you be picking stocks based on your tax bracket? Is that something H&R Block can do for me? Or do I need to go to an accountant specifically, or who helps with that and how?
Good question. You could try and do it on your own with knowing what the tax brackets are, knowing your ordinary income for the year and capital gains for the year. That's tough to do. You could potentially go to H&R Block. I doubt that they would have very detailed models to do that. I don't know if they do. A CPA most certainly could help you with that. You would pay them either hourly or for the project. And some fiduciary investment advisors also offer tax review, where they'll analyze your past tax returns or your upcoming potential taxes, and then analyze where you are within a tax bracket to try and help you maximize those lower tax brackets. The fiduciary investment advisors can't give specific tax advice unless they're a CPA. So what we do is we analyze our tax situation for our clients, and then confirm that with their CPA before acting on anything.
Got it. Thank you.
Sure.
There's one more question here.
Yeah.
With the current and potential future rate of inflation, wouldn't a lot of older bond strategies end up losing money now?
Yeah, that's fair. The U.S. Aggregate Bond Index, which is the Barclays Bloomberg U.S. Ag, that is usually the index used for bonds in the United States. And you can buy that index, the exchange traded fund version, ticker AGG. It's down over 2%, including the dividends it's paid over the last year. So yes, as inflation moves higher and interest rates move higher, bonds likely will struggle and some will have a loss. So you need to perform well. I mean, they still serve a place in helping protect a portfolio from major stock market corrections, but there are likely other places that you could outperform bonds by taking other types of risk within the bond market.
Got it.
Yeah.
Cool. Next slide.
Yep. So I alluded to exchange traded funds, and they are similar to mutual funds in that they hold a basket of stocks or basket of bonds or basket of commodities. The difference is, one big difference is they trade throughout the day, just like a stock on the stock market. It prices every second. And you can buy an ETF, an exchange traded fund, throughout the day, just like a stock or a bond. They're also more tax efficient than a mutual fund because the way they're structured, they don't have to pay out the capital gains distributions at the end of the year like mutual funds do. Now, there was proposed legislation to force them to do that like mutual funds last year, but it ultimately did not pass. So I don't know how long that the tax efficiency advantage ETFs will have. It's here for right now. And so we do like exchange traded funds. The fees on them are usually slightly lower than mutual funds for similar investments. But overall, exchange traded funds are very efficient. They're a great way to diversify into different types of stocks or different types of bonds without going out and buying individual stocks or individual bonds. So advisors usually use a blend of mutual funds and exchange traded funds depending on the underlying fees and the strategy for each client's portfolio. But ETFs are a great way to invest in an index or a broad basket of investments. So we do prefer to use ETFs pretty extensively for our clients.
Got it.
The last type of fund here is interval funds. And most folks don't know much about interval funds. And my guess is more and more people will learn about them because of the advantages that they may provide. So they're similar to a mutual fund. They look like a mutual fund. They're usually a 5-letter ticker that ends in X. It prices every day at the end of the close of the market every day. The difference is interval funds are much less liquid. You can't sell them every day like you can a mutual fund. They're typically only allowed to be sold one day per quarter. So you can think of them kind of like a 90-day CD in terms of their liquidity. So you would have once every 90 days, you'd have the ability to sell your holdings on that day. And by taking on that illiquidity risk, the fund can invest in much less liquid investments, less liquid bonds, less liquid mortgages, less liquid notes, and less liquid stocks. And when you look at taking on illiquidity risk, if you don't need full liquidity, interval funds are a great way to invest in illiquidity risk, which right now is paying very, very well. And we anticipate it will continue. We don't know for sure, but we think illiquidity risk will continue to pay well. Because interval funds are less liquid, they're usually only available through fiduciary investment advisory firms, because you need to make sure that each individual client in that portfolio can handle the illiquidity. But they tend to pay higher dividends and interest payments, and can invest in areas of the market that are just unavailable to traditional ETFs, mutual funds, stocks, and bonds. Uh, there's a private interval fund called Private Shares that invests in private companies before they go public, like Turo, SpaceX, some of those companies, so that they're trying to get in before they go public and hopefully have a large gain when they go public. So interval funds are a great way to invest in illiquidity risk. Again, you've got to be very careful with them because they are illiquid. They're not for everybody. And some of them have accreditation requirements in terms of amounts of assets that a potential investor has, or their income level to be able to qualify to purchase them. So interval funds are nice. Some people think of them as a blend between a mutual fund and a hedge fund. That is a reasonable way to look at them, but there's a place in some portfolios for most clients.
Interesting.
Yeah.
Could you tell us a little bit about, someone asked, well, I'll start with this one. What are the investor requirements to participate in interval funds?
Usually, you just have to go through a fiduciary investment advisor. So they're usually not available to traditional brokers. It's usually through advisors, and some of them will have an accredited. So you would have to be, quote, accredited investor. From a high level, an accredited investor needs to have $1 million net worth net of their home, so without your personal residence, and that's because they're more risky and there's more risk involved. You can also be an accredited investor by having income of $200,000 per year or $300,000 per year, depending on if you're single or married. Would also get you into that accredited investor space. And it's really, these funds have their roots back in the 1940 Act. And it's a way to protect investors from getting into investments that they don't understand or can't financially handle, especially if there is a loss, is really the reason that there are investor requirements with most of them.
Got it. So another semi-related question. Someone asked if you can say a word about target date funds, the pros and cons of those versus individual funds or life strategy funds. I'm not familiar with life strategy funds.
Yeah, that's a great question. So target date funds are designed to get you from where you are today to a targeted retirement date. So maybe 2050, 2045, 2030, whatever it might be. And so they're really risk management funds. So you want to have part of the fund in stocks, part of it in bonds. A target 25 retirement date will have much more bonds in it because it's very soon, versus a 2060 retirement fund, which has a long way to go. I think they're a great way for very passive investors to invest some or all of their retirement savings. If you don't want to take a lot of risk and you want to just set one specific goal of retirement, and that's what this money is going for, that's totally fine, and you'll probably do okay. If you're investing for other reasons outside of a specific date, then they don't, of course, they don't serve as well of a purpose. So it's better to invest for what your goals are for that money.
Got it. Okay. Let's see. We go to the next one.
Index funds. Index funds are based on an index. So if you hear of the S&P 500 or the NASDAQ 100 or the Dow Jones, those are the three most common indexes. And they're a basket of stocks that are tracked. And there are both index funds for stocks and index funds for bonds. Like I mentioned, the Barclays Aggregate Bond Index is the biggest one for bonds in the US. Dow Jones tracks the 30 largest, or not 30 largest, but 30 large cap US industrial companies. The S&P 500 tracks approximately 500 of the largest US public companies. They're very efficient. They don't change much in terms of what the composition of the stocks that are within them. And they're typically very inexpensive to access. So you can get an index mutual fund or an index ETF with very low underlying fees to access a wide swath of different types of stocks. So index funds track an index, and we find them pretty handy in asset allocation.
Great. Let's see.
On to fees. Fees typically have different forms, and there are brokerage commissions, and then there's investment management fees. So there's really two different professions within investments here in the US. One is brokers, which are held to a suitability standard, which means brokers need to provide suitable advice, which is very subjective, of course. Whereas registered investment advisors are fiduciaries, which mean, like a doctor or an attorney, we are required to provide the best advice at all times for our clients. And brokers make a commission on selling a product that has to be suitable, whereas investment advisors invest their clients' assets ideally with the lowest fee, underlying fee, and the lowest risk based on their return goals. And so fees are very different between the two. Brokers typically make a commission when they sell a mutual fund or an annuity or a life insurance product, anywhere from 5 to 10% of the value, whereas an investment advisor would be paid over time on the assets that they manage. So if an investment advisor is managing a portfolio that's, say, $500,000, and they're charging 1% per year, they would make $5,000 over that year. So on the flip side, if you had a broker and they sold a mutual fund that had a 5% commission, they would make $25,000 on day one, which would take 5 years or longer for the investment advisor to make. So very different motivations between the two in terms of how long the relationships may last, and where the motivations are to either sell a product or give you advice. Now, moving on from the difference between brokers and investment advisors, you then go down to, well, what are the underlying investment fees? So the ETFs and mutual funds will have their own, and interval funds will have their own underlying fee. So you're paying the company who is providing that mutual fund or that ETF or that interval fund, you're paying them for that basket of stocks or basket of bonds. And those can range anywhere from 0.03%, so practically free, all the way up to 2 or 3% for very exotic investments. And so weighing the risks and potential returns of different types of investments will lead you into either lower fee or higher fee, depending on what you're trying to accomplish. If you're just looking for low fee, you can buy ETFs or mutual funds that are very, very low fee and very passive. If you're looking for very exotic interval funds, they may have a higher fee, but they'll also be investing in areas of the market that you wouldn't otherwise have access to. So most investors are willing to pay a slightly higher fee to access those areas and an active manager. If you are buying stocks or bonds directly, there's no underlying fee besides potentially a transaction fee. So you may pay the brokerage house a transaction fee to buy those stocks or bonds. Some brokerage houses don't charge fees on those anymore, so those might even be free. Like Charles Schwab and Fidelity, I know on most of their stock transactions, there's no commissions anymore to buy individual stocks. So it's good to understand what you're paying for, the service that you're paying for. Is it an advice or is it a commission? And then what are the underlying fees of the funds that you're using, and are they worth paying?
Cool.
And then the last kind of way to wrap around all of these investment ideas is to build a plan. And I don't remember if it was Patton or Eisenhower, they said plans are nothing. Planning is everything. And that's very true, because you can make a plan and it never goes exactly to plan, but at least you're directionally headed in the right way, and you can make corrections day to day or month to month along the way. And everyone's unique with their own situation in terms of income, age, what they enjoy doing, how much risk you're willing to take, your lifestyle, your expenses. And so it's very important to tailor an investment plan, and ideally a financial plan, to meet those different variables for each individual client. And even within a household, a husband and wife, or a whole family, you could have potentially two people in a relationship that have very different risk tolerances and maybe different lifestyles. And so you need to account for that when you're building investment portfolios for each person or for the household as a whole. So it's usually beneficial to build a financial plan where you have a path of where you're headed, determine how much risk you need to take to get there, and then don't take on excessive risk, because that may actually reduce your probability of success. So take just the amount of risk you need to meet your goals, and have someone there to help you with that along the way, or become versed in it very well yourself and spend a lot of time researching and implementing those investment ideas, tax strategies, and portfolio allocation. So it's ideal for you to understand where you're headed, understand how much risk you can take, and then target that when you're building out an investment portfolio.
Wonderful.
And that's, from a high level, that is investing here in the United States.
Cool. I'm not seeing any questions pop up quite yet. I'm guessing we'll have some shortly here. Going back to the interval funds, that was something that I'm not very familiar with, and I'd love to just to ask a little bit more about that. Tell me a little bit about if you're in an interval fund and say you decide, I absolutely need to have this money, I'm having an emergency, is there a way to pull it out? Are there penalties or fees, or is that just locked away no matter what?
That is, in nearly all cases, it's locked away no matter what. So investing in an interval fund, you are knowingly taking that money and locking it away, and you're not going to have access to it. There is a very tiny private secondary market for interval funds, but to sell into those, so that would be like you would be selling your interval fund holding directly to another person. You're going to lose a lot of money, because of the buyer to give you that liquidity is going to want a lot of a large discount, and likely a transaction fee. And there may not even be a market for you to do that into. So for all intents and purposes, no, you won't have access to that. And there can be times with interval funds that they can even gate or throttle the amount that's being sold each quarter. So that if everyone puts in a sell order at the end of a quarter, they'll say, well, we don't have that liquidity. We're going to limit that to 5% of the fund's value each quarter. So they can really stretch out the duration that it takes to get all of your money out of an interval fund.
Got it. Got it. So there are some more questions here. One is, what is the best way to get started if you are in your 40s and do not have a portfolio at all?
Great question. If you have a way to save through an employer plan, like a 401k or 403b, that's a great way to start. It's mostly automated. It's tax efficient, and the investment lineup within those plans is reviewed by a fiduciary. So you would be accessing some reasonable investment options. If you don't have that, then opening your own investment account, either just a regular brokerage account, an individual brokerage account, or an individual IRA account, and saving money into that, either putting a large deposit in right away, or once a month or once a week, just periodic deposit, and just buying into some of these funds that have a basket of stocks or basket of bonds within them. That's really the easiest way to get started. and dip your toe into it. And there's a lot of online brokerage firms that it's easy to open an account and link your bank account to do that.
Cool. Do you have any general advice on investing, saving for a house? For instance, like a short-term investments versus high interest savings account for buying a house in less than 4 years, for example. And this person says, especially since high interest savings accounts have such small returns at the moment.
Yeah, that's a really good point. We run into this with our clients as well. There are some online high interest savings accounts that we utilize for some of our clients. Ally has traditionally had a reasonable interest rate attached to it. As interest rates move higher, likely move higher over the next year or more, you will start getting some interest out of these high interest savings accounts. So that's one thing to keep in mind. There are funds, ETFs and mutual funds, that invest in short-term bonds, investment grade bonds, and even short-term high yield bonds that will have a higher interest payment than a savings account. So that's one area that we sometimes utilize, are short-term bond funds. And another area, if you're looking out beyond 3 years, you could potentially invest in some income funds. And there's lots of different income funds out there. JP Morgan has one, PIMCO has one, DoubleLine has one. A lot of these big fund companies have income funds that have yields from 3.5% to 4.5%. They're more risky because they're investing in some lower rated bonds, but there is potential there for a higher return than a traditional savings account. So really, when you start with a savings account, you're there because of the safety. When you move into short-term bonds, you're taking some incremental risks there. They're not as safe as savings. And then in these income funds, they're not as safe as shorter-term bond funds, but of course, you're likely going to get a higher return or potentially get a higher return. So it's weighing those risks, but that's generally how we look at it at our firm.
Yeah, that makes sense. Someone asked, and the person who asked that question says that was helpful and thank you. Someone else asked, what are your opinions on NFTs, cryptocurrency, and digital real estate?
That's a good question. Although I'm for the industry, I'm relatively one of the younger advisors out there. And in general, the consensus from financial advisors is that those are high risk. So one thing that I look at with Bitcoin and other cryptocurrencies, it kind of, just a personal story here. I went out and bought some with one of those, it was like an ATM. This was, I think, in 2009. It was a long time ago. But in any event, it printed out a little QR code and, oh, this is neat. I've got a couple of Bitcoin coins, filed it away. I have no idea what that piece of paper is. It's probably worth as much as my house is anymore, but I have no idea where it is. And it really doesn't have any value besides the piece of paper that it's printed on and what someone else is willing to pay for it. There's no intrinsic value. Whereas a dollar bill is backed by the full faith and credit of the United States government. So we have something to rely on with that. With cryptocurrencies, there is none. Well, there is one. There's I think it's the US dollar coin. For every coin that's out there, there's one US dollar in a safe somewhere. So that one does have some backing that may give it some legitimacy. But with any other cryptocurrency, it's purely speculative. There's no intrinsic value and therefore is incredibly high risk. And while you can make a lot of money in it, of course, and some people have made a ton of money, there's very little in terms of safety net there. So you could potentially lose all your money when someone says, well, yeah, this doesn't have any intrinsic value. It's really not worth anything. The technology it's built on, blockchain, is very valuable and useful technologically, but the value of the coin itself is really only based on what two people agree it is. There's nothing backing that up. So we find them to be very high risk. Of course, we have clients that invest in it and we do the research and we can advise folks on them, and we have Bitcoin and other models, but they are, again, very high risk. So I wouldn't be putting a ton of money into it. I would use it, just play money, very speculative portion of your portfolio. Same thing with NFTs, other digital real estate. There's no intrinsic value. There's nothing backing that up. So again, high risk, high speculative investment, but the potential is there for reasonable returns.
Cool. I think that looks like that's all the questions we have. We're close to the 12 o'clock mark, so probably wouldn't hurt to wrap things up a couple minutes early. Do you have any last things you want to share with us, David, before I?
Well, the investment universe, there's so much more out there and so much to be known. It's really hard to wrap your head around and your arms around. So I recommend utilizing all the resources you can, especially professional help. And that's the same on the tax side as well, where if you're in a weird tax situation or you're making a lot of money or you're buying or selling properties, something like that, use a professional. Usually it will pay off in spades and give you some emotional comfort as well. So I appreciate everyone's time and interest in investing, and I hope this was beneficial to all of you at some level. Thank you.
Oh, David, one more question came in.
Sure.
And this is kind of interesting to me. What about using Bitcoin as a hedge against inflation?
Yeah, you can do that. It's interesting. I was reading a research report out yesterday, Bitcoin and its correlation to stocks and bonds. Bitcoin has a very high correlation to stocks when they go down. So when the stock market goes down, typically Bitcoin historically has as well. You could use it as a small hedge, but it's very speculative. So if as interest rates move higher, the value of Bitcoin will tend to go down, all else equal, because now you can get something that's going to pay you some interest that has a full backing versus something that's purely speculative. So as interest rates go up, it puts pressure on stock prices and other risk assets, because now you're getting a higher return out of a lower risk vehicle. So yes, it could potentially be an inflation hedge to some extent, but again, it is going to be a more volatile, more bumpy ride than other types of inflation hedges.
Interesting. Well, I really appreciate it.
My pleasure.
It's been a really interesting webinar, and I definitely learned a lot. I think other folks have as well. And on behalf of Advice Chaser, I want to thank you, David, for taking the time. Appreciate all the attendees for showing up, asking great questions, and participating with us. You will get an email if you're an attendee with a link to a replay of the event, and you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who is a great fit for your life and your financial questions. Our matching service is free, and every one of our advisor partners has committed to offering a free initial consultation to anyone we introduce them to. You can find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Bye, everybody. Let's see.